Hello, everybody. I'm Dominic Hobson, co-founder of Future of Finance. Welcome to our webinar, Stablecoins Will Be Regulated. What are the implications for the markets? Thanks to the work of an alarmed group of 7, the G7, which has directed since 2019, when Facebook, as it then was, unveiled a stablecoin called Libra, as it was then called, we now have a global consensus on how to regulate stablecoins. Regulatory status will be reserved for the asset-backed variety. Algorithmic stablecoins are anathematized. Issuance of regulated stablecoins will be to banks. The asset backing behind a stablecoin must be visible, must be of the highest quality, and must be domestic only. Regulators do not want a stablecoin going global and undermining the monetary sovereignty of governments and the control of monetary conditions by and through the banks. The issuers must also put proper in place. Effectively, stablecoins are being brought within the regulatory framework applied to banks. Banks have, of course, issued stablecoins already, most famously the JPM coin from JP Morgan. 2 banks in Australia have issued stablecoins in the last few years, all of which has an obvious implication. Any runs that develop on bank-issued stablecoins will be halted by the central banks, ultimately at the expense of the taxpayer. And runs will happen. Just as money market funds experience difficulties maintaining their par value, asset-backed stablecoins will experience difficulties maintaining their pegs. Now, whatever that might lead to, the regulations are now being put in place. Japan has already taken the necessary measures. The United States, the United Kingdom, and the European Union are in the process of doing so. So, will stablecoins replace bank deposits? Will stablecoins starve the markets of high-quality liquid assets, the famous HQLAs they need for their liquidity ratios? Does regulation sound the death knell for algorithmic stablecoins? What will regulation mean for the non-bank stablecoins that underpin trading activity in the cryptocurrency markets today? And if we have regulated stablecoins, do we still need CBDCs? To help us answer these and other questions, Future of Finance will next month be publishing a paper on the history of stablecoins, their origins, their status, and their prospects after regulation. We will, of course, be sending copies of that to everyone who is registered for this webinar. But there is more. Today, we are joined by 4 experts in the field of stablecoins who are eager to answer your questions as well as mine. Ricardo Correa is Global Head of CBDC and Digital Currencies at R3, where he and his team work with private and public sector organizations on the development of markets for digital currencies and digital assets. Daniel Eden is Advisor and Solution Architect at the Bank for International Settlements Innovation Hubs in Switzerland and Hong Kong, where he is involved in a variety of central bank projects on blockchain-based payments and currencies. Keith Baer is a fellow at Cambridge University's Centre for Alternative Finance, which is part of the Judge Business School, which he joined from IBM, where he worked on IBM's first ever blockchain project way back in 2017, the bilateral netting of FX trades with CLS. Keith now works with fintechs, exchanges, and central banks. Jana Baker-Taylor is Vice President, Policy and Regulatory Strategy in the UK and EU at Circle, a financial technology company which also happens to be the issuer of the market-leading USDC stablecoin. In addition to our panelists, we do, of course, also have you, our audience, and all 5 of us encourage everybody watching or listening to submit questions and comments throughout this webinar by using the Q&A functionality at the bottom of the Zoom screen. I won't be saving your questions and comments up to the end, but I will be putting them to the panel as we go along, so you can be an integral part of this discussion right from the outset. I'd like to begin by asking our panelists about that regulatory consensus. As I indicated a moment ago, Japan has amended its Payment Services Act. The European Union is moving via the Markets in Crypto Assets, the MiCA regulation, in the same direction. The United Kingdom is planning to amend its e-money and payments regulation and banking acts. And the United States President has issued an executive order to bring stablecoins within the regulatory perimeter. So this G7 consensus I referred to at the outset is actually coming to pass. My question, and perhaps I could put this to you first, Tina, is a twofold one, rather unfairly, a question with 2 parts. First, is the adoption of a common approach by regulators, according to the G7 plan, a good idea? I can see that it eliminates the risk of regulatory arbitrage, but it possibly also reduces the scope for experimentation and innovation. That's my first question. Is a common approach a good idea? Secondly, is bringing stablecoins inside the banking system, and you're in a very interesting position to answer this, rather than allowing stablecoins to compete with the banking system, Does that mean stablecoins will enjoy the privileges of being regulated as banks, i.e. lender of last resort facilities, deposit insurance, or will they just bear the obligations? Tina, what's your view on those two issues?
Well, thanks, Dominic, and thanks very much for inviting us to join in the discussion today. So, is global harmonization or, G7, G20 harmonization a good thing? I think if we look at how we are accelerating from an innovation hype cycle perspective and the global flow of value that moves around the world already today, then it does seem that the alignment and harmonization where possible of regulatory regimes specifically for this particular type of asset class makes a lot of sense. I think what that also kind of conjures up is competitiveness concerns by different jurisdictions, and how can they attract business and innovation and growth to their specific countries or jurisdictions while still aligning and harmonizing the way that they treat these assets that allow the flow of value around the world at a hyper speed, unlike what we've seen previously. So I think there's a couple of areas where there's already neat alignment. So any country that already had an e-money type of regulation before, if you look at the characteristics of stablecoins or digital currencies, which is how we refer to them, they are very likened to e-money. And so applying an e-money regime to this asset class makes a lot of sense in a number of ways. There are countries that don't have that. So you mentioned Japan and the US. And so trying to figure out how to classify these assets and which regulator should be overseeing them has been more of a challenge, where the UK and the EU already have e-money. Now, there have been challenges around, again, coming back to the competitiveness issue. If you're looking to really reinforce the monetary stability of your own particular currency, and historically the majority of stablecoins have been US dollar denominated, then there is this juxtaposition around the flow of value and kind of carving out not necessarily protectionist, but a defensive position if your home currency is not a US dollar currency. And so I think that's where we're seeing some of the friction. Your second question, remind me again.
My question is a bit of a cheekier one. It's that you're a non-bank
yes.
issuer of a stablecoin. Is this going to privilege banks in some ways? I mean, did you welcome this regulatory consensus or not?
Yeah, so from a Circle perspective, we've always been pro-regulation. So this is a forward positive move for us. We hold all of our reserves, 100% of them, in regulated financial institutions. So for us, banks are a critical partner. Now, in the future, if we were prudentially regulated, would we see value and benefit at having an account at the Fed or an account at BOE and being able to access that central bank window to house our deposits, our reserve holdings there? Of course. And I think that would be in many interests. But today, holding those deposits in commercial banking institutions is good for those banking institutions, right? And so there is a symbiotic relationship, and I believe a contribution to the banking sector. So in the US, for example, we have a number of deposits that are specifically held within minority depository institutions, which then increase the value and the stability of their balance sheets, and allows those smaller banking institutions to grow. So I think it also potentially raises the question that you mentioned at the end of your introduction around if privately issued stablecoins, which use open source technology, so it's constantly upgradable and very agile in the way that those systems are maintained, are able to hold their reserves one-to-one at a central bank, what do we need a CBDC for? Certainly at a retail level. And so I think that potentially opens that question, because it looks a lot like a synthetic CBDC in that case.
Well, I'm sure that Ricardo and thank you for that, Tina. I'm sure that Ricardo and Daniel have some thoughts on that. Before we hear about that last point you raised there about do we need CBDCs, Keith, I know that the Judge School keeps an eye on the way regulation is evolving right across the blockchain tokenized space. What's your reaction to what do you think the implications are of this regulatory consensus actually being put in place? What does it mean for the way stablecoins are going to develop, and in particular, what does it mean for non-bank issuers of stablecoins? Will they need to get banking licenses?
Well, it's kind of hard to predict exactly what the implementation of this regulation is going to look like necessarily. I mean, obviously there are some jurisdictions, as in Europe, for instance. You mentioned MiCA, for instance, and from memory, that will hopefully get voted on. I think it's in April now. It's just gone back to April from the early part of this year, in which case the stablecoin element of MiCA will become into operation. I think it's May 24. So it's still a little way off. Maybe that's the most advanced in many respects, but what happens in other jurisdictions, I guess, remains to be seen to some extent, as we still await the detail. On your first question, though, it's just worth bearing in mind, I think, another advantage of that consensus coming out of the G7, et cetera, is, I think, for developing economies who tend to follow the lead, maybe at the major jurisdictions. So I think if there is that kind of a consensus on how the recommendations are being implemented, that certainly helps developing economies as well to understand how and what approaches they should be taking to implement regulation for stablecoins in their own right. The other nuance I would just add, going back to your opening introduction on JP Morgan, when you mentioned JP Morgan coin, for example, I do think we need to differentiate between stable coins like USDC, for example, with the backing they have, versus tokenized bank deposits, which essentially is what a JP Morgan coin is. So they are different as far as regulation is concerned, because obviously with the tokenized bank deposit, it sits within the regular banking framework and therefore doesn't have such a focus from a regulatory point of view as does a stablecoin, which has to demonstrate, auditability of the backing, composition of the backing, and all the other factors that are relevant for a stablecoin as well.
And you need to be a JP Morgan client to use it.
Yeah.
Exactly. So it's in a closed universe. It's not available generally in the market.
Having said that, it is spreading out into networks. In terms of, I'm not sure if we'll be talking about Partier later, but some of the other efforts that are going on, the way that JPM coin is being used, I think they're now claiming over $1 billion per day as actually being settled using it primarily in repo. So the participants within repo transactions are using it as well. So I think it's not necessarily constrained to yes, trading participants with JP Morgan, but not necessarily closed.
But I guess it's probably tri-party repo, isn't it, where the bank is still standing in the middle there, even if they're raising the cash from some third parties. But that's an interesting point you make there, Keith, and a very important one. Not all stablecoins are actually stablecoins. Actually,
exactly.
Daniel, what's your thoughts about the last comment there that Tina made, which is that, do we actually need CBDCs anymore?
For retail.
Yeah, point of detail.
I was specific about retail CBDCs.
Okay. Do we need retail CBDCs anymore?
Thank you for the
get wholesale ones by the sound of it. Do we need retail?
Yeah, thank you for the clarification, Tina. And maybe I'll just remember to say that my opinions are my own and not necessarily those of the BIS. Just before we get started, I think it's interesting. Just adding to what Keith just mentioned about making a distinction between stable coins and tokenized deposits, maybe for lack of a better name. I think CBDCs carry the same degree of ambiguity when we start talking about CBDCs. The distinction made between retail and wholesale. So focusing on retail CBDCs used for domestic purposes. Yeah, I mean, one could argue that it's a zero-sum game between retail CBDCs and stablecoins, especially if stablecoins have access to central bank balance sheets, as a backstop and as a provider of liquidity. But another way of looking at it is to eliminate the zero-sum game function and to say that maybe these things have the ability to interoperate and to coexist. So an example of that might be a central bank wholesale CBDC that could be wrapped in the form of a retail token that could be available publicly, not necessarily maybe on a public chain, but have access to the general public within a specific jurisdiction. So I would encourage to not look at it as a zero sum, as either this exists or that exists. There's a lot of nuances around design and architecture, and how that design and architecture can support domestic policy goals and international spillovers and things of that nature. And I think what's certain is that when we look at a lot of CBDC designs, it's very clear, especially in a retail context, that central banks will not do everything on their own. Central banks will ultimately rely on public-private partnerships for many things. Adoption is, of course, top of mind to make sure that these things, that these services go to the last mile and are actually adopted and useful. So in that sense, I think that they can definitely coexist, and they're not necessarily at odds with each other.
But in order to, and Ricard, I'm itching to hear what you have to say about this, so do say something in a minute. But if we're going to have this great variety of means of payment, of digital currencies, digital monies, if you like, they're going to have to interoperate, aren't they? And I'm not sure that I'm seeing a lot of discussion about how that's going to work, but maybe I'm not paying attention. How are these things going to be made interoperable in the end? If we end up with a system like the one you've just described, where a CBDC is like the central bank money layer that we have today, and then you get a great flourishing of different forms of commercial bank money, if you like, sitting on top of that, whether they're wrapped or unwrapped or tokenized or stablecoins or tokenized bank deposits, it starts to get very complicated. And if you've got customers, whether they're business customers or retail customers, trying to choose which is the best medium of payment for this particular transaction, it's going to be quite complicated in terms of getting the data to them to make that decision. And that decision is not seamless if these currencies are not interoperable. How do we make them interoperable? Is there a magic bullet for that?
Well, I don't know if there's a magic bullet, but the one primary concern or question that I have around the CBDC pilots and architecture designs that we've seen discussed most often. There's like 105 CBDC projects worldwide, and Daniel would definitely know more. But they're not, for the most part, using digital ledger technology. They're not using open source blockchain technology, certainly not as the basis. And so I think when you consider cross-border, so we're talking about, Daniel mentioned if we were using this just within one country for domestic payments, then, what happens around cross-border payments or cross-border remittances? And then do you have to, again, kind of switch that out? One of the other things that I've seen recently, and I think it's just still a topic of discussion around the ECB's plans for the digital euro, were, a limited amount that you could hold. I think it was 3,000 euros. And there was this period of time where it was use it or lose it, kind of like a voucher for Starbucks or something. So to me, I think that kind of those types of design questions are critical, because you don't want to have this closed loop network that then doesn't integrate with the rest. And we don't have, transaction caps on Visa transactions in and out of Spain, for example. And so I'm sure Daniel has a more articulate view, but for me, it's either we're all going to be using the same type of architecture and infrastructure that might be permissioned in some way, or we're not, and that's going to create challenges.
Ricard, you were about to say something, but perhaps you'd address the point Tina's made there about these spanners or friction the EU is throwing into the machine to protect bank funding, basically. But what were you about to say before that?
Yeah, I think, well, first of all, thanks for having us on. I think Tiana raises some good points. There's all these various controls and measures that the central banks are looking at in order to kind of protect, investors and users of digital currencies. I think the question around interop is really interesting. Certainly, we've, as an industry, been looking at that for many years. The last 7 years that I've been super focused in CBDCs and stablecoins, interop continues to be kind of this elusive goal that we try to kind of get to. And I think there's more and more efforts today We've seen lots of different bridges developed for different types of technologies. I think we do need eventually to get to a point where there is a pattern that we follow in order to allow currencies to kind of be interoperable and assets more generally. Otherwise, we'll create the same siloed world as we have today, more or less, where we have these very kind of brittle way of integrating kind of disparate technologies and systems, or different technologies and systems. ISO 20022, we all know, and we talk about kind of payments interop and a standard for payments. I think it's taken many, many, many years to get to ISO 20022. And so do we sit and wait? No, I don't think that's going to be the answer. So, you know, there's interop work happening in all the projects certainly that we're involved in. I wanted to pick up on an interesting point that Tiana mentioned, 105 odd CBDC projects out there. And I think you said most being kind of centralized. I'd say to you that there's a good balance there, certainly from my perspective, where there's a lot of work being done in exploring what DLT might provide in terms of benefits. Not to say that those projects will actually go DLT eventually, but certainly it's in the mix and in the conversation. And then the discussion is interop between different DLTs, or is interop between DLT and centralized incumbent systems? And so we bifurcate these things. Interop, we reserve for DLT interoperability, say Ethereum to Corda and other DLT platforms, Hyperledger. And then integration, we reserve for kind of emerging technologies, DLT, to be able to integrate to incumbent systems, RTGS systems, collateral management systems, identity systems, and so on. And those two areas continue to be kind of areas of deep research. Integration to incumbent systems seems easier because we've developed a whole bunch of microservices and APIs, right, that allow us to integrate, but that's at the data level. And so, listen, I think from my perspective, yes, we do need to get to a point where interop of these various systems is standardized. I don't think we're going to get there anytime soon. And so in the meantime, you know, we'll continue to kind of build bridges and build these somewhat very proprietary systems in order to allow assets to be kind of exchanged or at least settled across various systems.
Can I make a quick point on what Tina was saying on, do we actually need a retail CBDC if we can have regulated stablecoins? I mean, I think there's one factor which says that we probably do, at least from the central bank's point of view, which is many central banks, and it's been said multiple times, I think, see their mandate, including giving access to fiat currency, meaning central bank liabilities as opposed to a commercial bank liability in the case of a regulated bank issued stablecoin, to the general population. So, for example, the good example, I think, is in Denmark, where there's, you know, banks are now not holding currency cash in their bank branches anymore, which is causing bank robbers to have to find new careers in that kind of respect. So that gives an illustration, I think, of some of the extreme levels of cash not being used by the general public anymore in many jurisdictions, and a need from the central bank's point of view to maintain the connectivity and the levers that they have through what was historically cash distribution to something which they can manage themselves through intermediaries, probably, in the case of a retail CBDC. So I think that continuing to give access to essentially our central bank liabilities to the general population and to general commerce isn't going to go away. And they're probably, therefore, in many cases, not all cases, will be seen as a requirement for a retail CBDC as well.
Mm-hmm.
Yeah, well, Keith, I was thinking that earlier, like, I think if you assume that the central bank doesn't issue directly to retail, you go, well, you default to cash. Because I believe the Central Bank Act requires the central bank to provide a central bank liability to your general domestic population. So, but if cash then is declining, well, what option do you have?
Yeah, exactly.
So at that point, there's going to be I suppose there's going to be an inflection point where you go, well, I'm not going to issue directly because that carries with it a tremendous amount of responsibility and obligation
and cost.
So do you create narrow banking opportunities, to kind of issue through the commercial banks, or do you provide the optionality to say this form of money has these properties and these features, and this form of money has a different set of property and features? Utility-based stablecoins seem to be kind of more of the focus now, so that there's some real value there, or at least perceived value. So, lots of research still going on. I don't think we've found the answer just yet, but your point is a very strong point. And
Okay.
certainly that
So
was clear in my mind.
we're
Could I come
starting to
in
get
quickly
some,
on the?
yeah,
Sorry,
Daniel, go ahead, but we've got some questions. So yeah, make your
Okay.
point.
I just wanted to come in quickly on the interoperability question. Maybe I can rewind back to that and give a little bit of maybe a different perspective on the interoperability discussion. I think that it's important when we think about interoperability to understand the inherent tension between the network effects in a payment network, that as the network grows and as there's more acceptance and access, there's more value to every participant, versus, you know, the fact that at the end of the day, every service provider in the private sector, at least, and to some degree in the public sector, wants to differentiate themselves based on something. So there's a natural tension with interoperability. And, you know, you can see this for anybody that's practicing in the industry. You can see this throughout all the working groups and kind of everything we're doing. So we all understand that there's a drive towards that goal, but at the same time, the practicalities of it are misaligned when we consider the incentives on each organization.
Yeah.
With that said, though, you know, I feel like a lot of the time the question gets asked in a very kind of idealistic perspective. We all need to interoperate. All these systems need to work together to create something cohesive. And to some extent, I agree. You know, the fragmentation of marketplaces is always a consistent issue that needs to be pushed back against. But you know, I would urge people to look at the markets today and ask, well, are the markets today fully interoperable? And even if we restrict our attention to a domestic system and think, for example, about commercial bank money, could you argue that, you know, here in Switzerland, for example, where I'm dialing in from, is my money at UBS interoperable with Credit Suisse? And in a way, it is, but in another kind of maybe more technical way, it isn't. When I pay somebody from my deposit account at UBS to their deposit account at Credit Suisse, there's a whole bunch of magic going on in the back end so that it seems to us that these two things are interoperable, where really I'm replacing a claim against one bank for a commercial bank claim against another bank. So I think it's nice to look at kind of practicalities of it and say, can we be more interoperable and less fragmented than today's system, as opposed to taking a more kind of idealistic view and saying, can all these systems seamlessly interoperate at a technical, legal, and governance level? So I'm generally positive that the answer is yes, if that's the context in which the question is asked about interoperability.
Thank you. As I said, we're getting some questions in. The first one is this. Do stablecoins need to contain central bank money to be useful in wholesale markets where central bank money is the rule? An example is SDX's tokenized Swiss franc for settlement on SDX.
I mean, just to maybe if I could pick up on that one, because it's a question close to my heart. I mean, I don't think they do, but clearly there will always be an advantage in central bank money versus synthetic CBDCs like Finality, for instance, which obviously is hoping to get into production towards the end of this year, I think, which is in effect a synthetic CBDC. So again, it's using the commercial bank's deposits at the central bank as the basis for the settlement coin, but isn't a liability on the central bank per se. And the SDX example, obviously that has value as well, because it does potentially create atomic settlement, etc., security, DVP. However, it's still a liability on a commercial entity as opposed to the central bank itself, other than Project Helvetia, which Daniel may want to talk about, which obviously has been using Swiss National Bank issued CBDC for the purposes of a wholesale CBDC. And I think Bank to France and others within the European community have also, making great strides in terms of how a central bank issued stablecoin for wholesale purposes can make a significant difference in terms of efficiencies as far as wholesale markets are concerned. So I think in summary, the answer is it doesn't need to be, but clearly there are going to be advantages when available in terms of wholesale CBDC per se.
I don't think any of you want to add to that, but this might be an interesting point before I move on to the next question here, because it's kind of they're sort of tied together. When we look at the assets which are backing the most popular stablecoins today, and I'm talking, Tina, of USDC, but also say of Tether, the model is that they disclose a bunch of treasury securities. It's not cash backed. Although we have seen this 100% cash-backed CBDC coming out of the Isle of Man, the pound coin. So clearly, with interest rates where they are, you possibly can make that model work. But there is this structure inside stablecoins, to make them worth issuing, you have to reinvest the cash to make a return on it, to cover the costs of and make money out of, make a profit from operating the system behind the stablecoin. Now, this question about, does a stablecoin need to contain central bank money? Well, so what if it's backed by US treasuries and US government paper, treasury bills? How much should we care about whether that's central bank money? In the end, it's government credit, isn't it? But anyway, here's Henry Rashan's question, which is related to this, I think. How can we ensure that the assets backing an issue of a stablecoin are ring-fenced for the benefit of the stablecoin holders and not able to be grabbed by an insolvency practitioner for wider purposes in the event of the failure of the stablecoin issuer? So stablecoin issuer falls over, it's got a bunch of treasury bills and bonds, those are seized by the insolvency practitioner and distributed to the holders. Isn't that what should happen? Do you ever think about that at Circle, Tina?
Yeah, of course. Yeah. So I think the first thing is Circle has two digital currency products. One, USDC, is backed 1-to-1 with US dollars. Today, 80% of that sits within immediately 30-day treasury bonds, and those are held within BlackRock, and 20% is in cash. So it's not 100%. I mean, obviously, you need to be able to have cash to make immediate redemption as and when your customers come back and would like their dollars back. Our second stablecoin, which is called Eurocoin or EuroC, is 100% backed by euros, and those euros are held in a segregated reserve bank account.
So by euros, you mean euro cash?
Correct.
You mean bank deposits, yeah?
Euro cash.
Mm-hmm.
So in that case, obviously, if there were a negative interest rate situation, which we've recently come out of, then yes, obviously that's probably a loss leading product. Today, interest rates, allow for those deposits to, earn net interest income, and so therefore that kind of supports the costs to issue those tokens. But Circle is a market, financial market infrastructure company, and we offer a whole suite of other types of services. And so being a stablecoin issuer is not the only thing that we do. With regard to how Tether manages their reserves, I mean, I don't work for Tether. I only know what's in the public domain and what they've shared. But, I do know that for Circle, we do monthly audits, exactly where, the money is sitting. Now we publish this number, so you can go and actually see which of those treasury bills that is backing deposit sits and where it lives. So there's an increased level of transparency. The bankruptcy remoteness question is one that comes up a lot in discussion with regulators around kind of segregation of customer funds. So in our ecosystem, customer funds, those reserve deposits sit in segregated reserve accounts. They're not our operating accounts. We don't commingle money. And so the model is that we hold $1 for every token we issue, and they're, redeemable 1-for-1. So if there were to be a run on USDC, there would only be a run to the extent that we were issuing or redeeming out the last dollars that we held in reserve. So that, I think, when we look toward what the regulatory structure might look like, there is a lot of focus based on what is the quality of those reserves that you're holding if you're not holding them directly in cash, and where are they being held, and what is the transparency around the reporting, are they indeed segregated? And as we've seen, in other areas of the digital asset market over the last year, and certainly with, an algorithmic stablecoin earlier in the year, where those governance mechanisms weren't in place, and then therefore once the peg was lost, there was a calamitous collapse of value. Circle just isn't structured that way. It's a very boring, easy to understand business model, and we're really proud of that.
But what about Henry's question there? I'm not sure you've answered that, where he's asking, you get these very interesting mashups, don't you, in the cryptocurrency markets, where somebody might end up holding stable coins when the stablecoin issuer, I'm not saying this is you, when the stablecoin issuer falls over. And so you get caught up in this complex series of insolvency maneuvers by very expensive lawyers and accountants. Henry's question is, I was a holder of this stable coin. Now it's caught up, as in Lehman Brothers. My assets ended up being rehypothecated, if you like, up the wazoo, and I can't get my money back for years and years.
You mean if you're holding stable coins in another ecosystem to which those assets have been frozen due to bankruptcy, like in an FTX situation? Is that what you're?
Yes.
I see. I'm sorry. I misunderstood the question. So yeah, that's a great question. And it's one that we're discussing with regulators. So, in our view, as the issuer of USDC, you should be able to come back to us anytime and redeem your USDC. And we hold those reserves, regardless of whether the token is sitting on this platform or that platform. Now, in the case of an FTX situation, we would argue that good business practices would demand that customer deposits, whether they be fiat or crypto, be held separate and segregated from any type of operating deposits or any type of operating capital of the company. That isn't the rule today anywhere. Now, there are some provisions for that in MiCA that will come into force, as we talked about. Those will come into force 18 months from April, so a little longer than the stablecoin provisions. But certainly those market integrity questions are critical ones to address. And the UK, I think, will be doing that in a consultation soon, and that is part of an ongoing discussion in the US.
Well, Henry's comment has attracted comments from other members of the audience. Somebody says there's a lot of uncertainty as to access of that cash backing. The legals are very unclear. Amarat Singh says it's very simple. You should have a similar regime to CAS, the protection of customer deposits introduced after the financial crisis in 2007-8, which gives the holders first rights. You've mentioned segregation there, and I imagine that's, in this country at least, complying with the CAS rules there. Paul Amory asked a very interesting question, which is
but CAS necessarily isn't. I mean, CAS protects those assets that are segregated in customer funds, right? But the question that you asked is, if I don't know, Bob's Donuts goes bust and you have money, invested in Bob's Donuts, or maybe Donuts isn't a great example, somewhere where you would have money on deposits or assets, that are being held by Bob, and Bob goes bankrupt, then that gets swept up into the bankruptcy process. And it sounds like that's what you were asking. The fact that
was what I was asking. Yes, the discussion's kind of moved forward here, where investors in stablecoins are asking if they are protected in the same way that customer funds are protected at an asset manager, for example. If the asset manager falls over, the customer cash waiting reinvestment held in a separate account at a separate bank, etc.
Well, yeah, it's a bit like FDIC insurance, I suppose, right? So if you put money in the bank up to a certain amount,
except FTX is not really regulated properly.
No.
Yeah.
What I'm saying is, yeah, if you're putting your money in a regulated and the money is sitting there as a deposit, that's fine. But once you take it out and you start using it, dollars are a oh my gosh, I'm having a brain moment where I'm losing the plot around they're a bearer instrument, right? You lose your dollar, you lose your dollar. Now, the fact that you had this dollar sitting in a bank account that was FDIC insured, like we're conflating two different things. I think if you've taken that stable coin and you've put it into a, I don't know, yield bearing product on a platform somewhere, and that platform does not use the same, good business practices or governance mechanisms in lieu of regulation, instructed them that they must, then yes, of course, your dollar is still sitting with Circle and we'd be happy to give it back to you. But if the token is locked up somewhere and you can't get to it, like we can't get to it either, right?
Anyway, Henry is staying. We better move on from this, but Henry is responding, saying, how do you prevent the insolvency practitioner from using the assets to settle the bill so the lights can stay on, the holders of fixed charges who want to sell the buildings and the computers, pay back wages of critical staff, allocate to mitigate the black hole that invariably occurs in these cases. Let's move on. I think, and maybe I could bring you in at this point, Ricardo, because Paul Amory asked a very interesting question. Why don't stablecoins pay the interest they receive on reserves out to the token holders like money market funds? P.S. Tether must be making $2.5 to $3 billion just in interest payments.
Dominic, I missed you went silent there for
Sorry.
Just at the beginning.
The Paul Amory is, why don't stablecoins pay interest they receive on their reserves out to their token holders? We're now in this positive interest rate environment. They're probably making a reasonable spread on the cash that's backing the stablecoin. Paul suggests that Tether is maybe making $2.5 to $3 billion in interest. And this raises an interesting question about stablecoins in general. I always think they're a bit like money market funds. And we've seen money market funds have to be bailed out twice in the last 20 years, 2008, again in March 2020, the beginning of the pandemic, because maintaining that par as a bit value of your money market funds, a bit like maintaining the peg against the dollar or the euro or whatever currency it is. And market conditions conspire against you, and a kind of run begins. And we have seen central banks step in to save money market funds. Are they going to step in to save coins as well? So I'm asking you two things really. One is, do you think that stablecoins should start paying interest to their holders? And secondly, is there a kind of structural flaw in stablecoins which is unavoidable?
So the first question, interest-bearing stablecoins, really interesting. I think as we see a proliferation of different forms of money, might that be an incentive that you add to your stablecoin in order to gain adoption? I think certainly we're not seeing that today. We know that it's kind of, to Tiana's point, if you've got negative interest rates, it's a loss leader. You've got positive interest rates, you can start to recover some of your costs and money. There's operational costs. So I think there's no yes or no answer to that. I think it's going to be up to the issuer to figure out what problem it's trying to solve and also what kind of adoption it's trying to achieve. And that could be an interesting lever that you might pull. I'd say that question is not only kind of related to stablecoins, but also CBDCs as well, where you're thinking about, is there an opportunity to add interest rates to CBDCs as a form of, driving adoption and gaining momentum on CBDCs. So yeah, interesting question. I think certainly that's a possibility. On the second question on the money markets, I think, they do share some similarities. Asset-backed stablecoins do share similarities. In terms of their structure, they're both backed by a pool of assets, and you're trying to maintain stability of the value. However, there is some differences. I think to Keith's earlier point, not all stablecoins are created equal. So, one structural flaw, as you mentioned, in money markets is that you could have a run on the bank. Investors drawing out kind of their funds, and all of a sudden the fund breaks the buck, and you introduce financial instability and so on. So certainly that's a possibility. I think the difference, though, and of course money markets are not insured, and typically you're investing in short-term debt securities, which can be subject to credit risk and interest rate risks as well. I think if you look at stablecoins that are asset-backed, we've seen asset-backed stablecoins, property, real estate, precious metals, other things which are less volatile perhaps and less susceptible to runs. So, the underlying asset, I think, for those types of stablecoins are less prone to these volatilities and interest rates and credit risks. So, they do share some similarities, but I think there are some differences depending on what kind of a stablecoin you're actually building and issuing. Mm-hmm. I'll stop there.
One thing I'd just add to that, Dominic, to Paul's question, the markets and crypto assets regulation that's coming out in Europe actually prevents it. It will be illegal to offer interest to holders of the token. So, a major trading bloc has already decided that that's not going to be allowed. Now, I'll just stop there.
Okay, but that strikes me as a while poor Tina recovers. I don't know if anyone wants to add to what she was saying to that, but maybe we could address Phil Mocken's observation here, where he says, why do we have a single type? Why do we need a single type of stable coin? Circle comments on high standards, but what's wrong instead with using competitive forces? Aren't the key issues to do with obligations around transparency rather than asset or liquidity quality and systemic risk? Now, Keith, I don't know if you've got some thoughts on this, or Daniel, but we're already seeing a degree of transparency from non-bank stablecoin issuers. You know, I can read a Grant Thornton account of what's backing the USDC. I can get something similar. It's not completely transparent, I might say, for Tether. So that represents a change which has taken place recently. Phil's point, why don't we just, you know, let 1,000 flowers bloom, have competition between all sorts of stable coins and let the best person win? The network effects, which you mentioned earlier, will triumph and so on. Daniel mentioned earlier. I guess a way of looking at this question is, how are non-bank stable coins going to carve out a profitable niche if the whole regulatory weight is moving towards bank-issued stable coins?
I mean, from my point of view, I think, I would combine these topics together. Yes, there's value in high standards, as Circle obviously make a strong point about. But also it comes down to competitive forces, choices on behalf of consumers and people who are trading, etc. And how brands and propositions and interoperability and all these topics actually have an impact on the utility of a particular stablecoin and what the benefit is going to be. So I do think it's, I wouldn't therefore separate these issues necessarily, because at the end of the day, for stablecoins, the market will decide.
Daniel, did you have an observation on that?
I agree 100%.
Uh-huh.
I think the only other thing that I would add, Dominic, is that if we're looking through the lens of stablecoins, as you know, we talked a lot about investment and, you know, comparing them to money market funds. For us, the original kind of birth of stablecoins was to be able to move value around without having to go in and out of, you know, the banking system or a fiat system. But really the use cases around not just specifically payments, but of value movement and away from kind of investment purposes into true utility, I think is very poignant. And if you look at how the regulatory community is assessing non-bank asset or, you know, fiat-backed stablecoins, you know, they're likening them to e-money. The UK is likening them to digital asset or digital settlement assets. The most prolific stablecoin bill in the US was called a payments stablecoin bill. So I think there has been a real shift in the way that stablecoins are used away from a asset allocation or an investment tool to utility. And I think that kind of matters, going back to the early conversations that we were having around optionality.
If I could just add to what Tina was saying. In fact, from a Cambridge point of view, one of our major research initiatives at the moment as part of our digital asset research is working with both stablecoin issuers, and thank you, Tina, for your cooperation on this, but also blockchain analytics companies to develop a digital money dashboard. And the idea here is to be able to, on an open access basis, be able to give insights into what stablecoins are available, how they're being used, where they're being used, all the kind of dynamics around that. And then over time, being able to position that against CBDC, retail CBDC, and potentially other forms of e-money, which understand how this evolution is going to happen on different types of payment mechanisms. And in particular, as Tina says, how the shifting way in which stablecoins are potentially being used in the more in the context of payments, for instance, rather than just facilitating trading within the crypto world.
Could this, Keith, develop into an app for consumers to find the cheapest to pay form of payment?
I mean, well, as I said, this is open access, so it's available to consumers, and we are including a big investment in terms of education to, in the interest of consumer transparency, et cetera, to increase understanding of what a stablecoin is, how it works, et cetera, how it's regulated. So we are putting a significant emphasis on education to make it more consumable by, retail consumers who may not be as sophisticated in their knowledge of stablecoins as people in this audience, for instance. Yeah. So it could be, though our primary focus in the first instance is working with regulators and market participants, but making it generally available to hopefully increase insight on that basis as well.
Okay, thanks. We're into our last 10 minutes, and there's one topic I would like to raise about stablecoins, which is their use in cross-border payments. And Daniel, I think maybe you're a logical person to address this question. There does seem to be a lot of interest in the potential of stable coins, even in the G7, which wanted to regulate stablecoins, in their possible use in cross-border payments. Yet on the other hand, regulators seem to want to keep these things domestic now. And there's been a lot of interesting experiments, which both you and Ricardo will know about, using CBDCs to settle cross-border, cross-currency payments as well. Is there a role for stable coins in making cross-border payments cheaper, faster, more transparent, which is a big regulatory drive from the G20?
Yeah, it's a great question. I think what I would say is that there's definitely a role for these new technologies, distributed systems, tokenization, cryptography, composable smart contracts, for lack of a better word, to eliminate a lot of the frictions in cross-border payments. In practice, though, what I see, if I answered that question kind of trivially, the answer would be, oh yeah, you can move a stable coin across borders, or in fact, any kind of tokenized asset across borders, and there's no friction, atomic settlement, and so on and so forth. But if you zoom out and consider the on-ramps and the off-ramps on both sides of that transaction that ultimately happen in a domestic context, a lot of the frictions go from the cross-border transaction itself to the setup and the teardown of that transaction, both in domestic contexts. So it doesn't really alleviate the friction at the moment. It just kind of pushes it to the sides and maybe hides it a little bit. And I think that that's where the focus should be. And when we think about stablecoin arrangements and you look at the frictions that exist in the on-ramps and off-ramps, it's not enough to say, oh, well, this stablecoin arrangement can move money around the world, faster, cheaper, better. You actually have to zoom out and look at the entirety of the transaction. And if we're talking about stablecoins in the context of payment and not as a store of value, then you need to assume that somebody is on-ramping the currency in a domestic context, moving it across border, and then off-ramping it in another domestic context, and think about that as one holistic transaction. And in that sense, it does make sense that regulators are focusing on the domestic context to look at these on and off ramps to understand where the actual kind of central bank liability that acts as a nominal anchor is happening. What are the effect spreads? And how can you kind of create liquid markets in currency pairs that ultimately a lot of the friction lies today, that you would like to eliminate to create currency pairs and frictionless trading between economies in their domestic currencies. So it's a really tricky problem to solve. In a naive sense, yes, distributed ledgers, tokenized assets, and by virtue of that, stablecoins can alleviate the frictions that today exist in, correspondent banking for cross-border payments, but that's not quite enough, I would argue. You need to kind of zoom out a little bit more and look at the wider context. And I think a lot of the problems just get pushed to the sides. So that's the challenge.
Yeah, if I could just
go ahead.
So I couldn't agree more that the challenge is the infrastructure. Just like, if you have a dollar, getting that dollar from here to here is not as easy as it would seem. So I think that's where bridges and partnerships come into play. So we issue a digital currency, and we do have financial market infrastructure for other open source networks to plug into that. And one of those is Stellar. So the Stellar Foundation, let's see, I think in December, finally announced their partnership with UNHCR. to deliver humanitarian relief, specifically in this first pilot to Ukraine and displaced people that have had to leave Ukraine. And they're doing that through Stellar wallets using USDC. And the cash out element is MoneyGram. So that is a traditional financial markets, company that has branches all around the world. There's also another service that's happening in South America. And for example, I get these numbers slightly wrong, so forgive me if they're off by a decimal point, but the transaction using a Stellar wallet and USDC to move money from the US to Colombia, on average, that would cost in the traditional system 5.6% of the transaction. Doing that with a Stellar wallet is 1.6%. So it's incredibly efficient and less expensive. But more importantly, there is that MoneyGram element at the end, which allows somebody to walk into a MoneyGram and cash out. Now they can cash out in dollars or they can cash out of their local currency. And so I do think that the store of value element can change importance depending on where you're sending that dollar to. So if somebody sends me dollars, that's not really useful to me. I'd rather cash out in pounds. But if I'm in El Salvador, maybe I want to keep the dollars. So I think that there's it's more complex than, are they good for cross-border payments or not?
Bill Mocken goes on to say, is regulatory arbitrage, e.g. On KYC, a primary use case for stablecoins? Do they expect stablecoin issuers and the infrastructure they use to comply with the FATF rules on countering money laundering and financing terrorism and sanctions and the rest of it? He also says, to what extent will stablecoins encourage a continued fragmentation of liquidity rather than improve it? So in this correspondent banking model, which has been mentioned by Daniel in particular, you've got these banks maintaining these pools of liquidity all over the planet, just so they can make sure they're ready to settle. And theoretically, a lot of this digital technology can fix that problem. My question would be, regulators want stablecoin issuers or the infrastructures they use to comply with the principles for financial market infrastructures. You can't be down for more than 2 hours and so on. You've got to attain these really high standards of resilience. Are the infrastructures being used by stablecoin issuers at the point yet where they can solve that liquidity problem Phil refers to, but also match the PFMI requirements and match the anti-money laundering, anti-terrorist financing rules as well? It's quite a lot of work to do to reach those sort of levels, isn't it? You're nodding, Tina. It means you've reached those points and you spent a lot of money to get there, I should think, yeah?
Well, certainly the money laundering and prevention of financial crime is something that Circle takes very seriously. I think the difference around applying PFMI to stablecoins as a regulatory regime, I think there's definitely some likenesses, but there are definitely some differentiators. And the primary one is that for all other PFMIs, they basically own all of the infrastructure. The rails are theirs for the most part. So if you think of a Visa or MasterCard, and in the Circle's case, the open source technology that USDC runs and is operated on is not completely, we are a wholesale company. USDC moves freely across 15 different layer 1 blockchains and bridges. And so there would be some gaps in the infrastructure that is under our control. And I think that is, an interesting question as we kind of look through and look into taking those legislative concepts and putting them into paper and a rulemaking oversight capacity to regulate.
And I think it's not just about the infrastructural question, it's also about the operational maturity. So we obviously know the challenges that FTX had in terms of operational maturity. But even in stablecoins, it's been reported, I think, that one of the major stablecoin issuers, not Circle, didn't have full backing for their stablecoin from time to time. So it's that operational maturity, I think, which is a critical factor in terms of being able to achieve 2-hour availability times, as you mentioned, Dominic, as far as PFMI is concerned, and having the maturity in order to be able to demonstrate the operational resilience that PFMI demands.
But how do you do that? I mean, Tina's just said that, USDC is available on these 15 layer 1 blockchains. The NAB stablecoin, which has been issued, is onto Ethereum and Algorand, I think. I mean, these layer 1s are all a little bit, quite a bit different. They don't interoperate very well. How can you meet those PFMIs if those are your distribution infrastructures? I think that's quite hard.
I agree with you. I think it is quite hard, and probably a whole new podcast is required to cover it. But I mean, no one's saying how easy it is, but it does set a benchmark. Mm-hmm. So at least there should be clarity about the sort of things that need to be achieved in order to hit the standards of resilience and security, et cetera, that are required for critical market infrastructures. And as stablecoin maturity increases and develops, that's what stablecoins will be, alongside what other critical market infrastructures we have.
Mm-hmm.
Maybe that's a good point to come in and think about competition and let 1,000 flowers bloom. I mean, right now there's a lot going on, but at the end of the day, if stablecoins, or at least the stablecoins that we're discussing today, are riding on top of public blockchains that ultimately don't have a distributed operating style with consensus-based validation, and if some of those fall over and die in the process, maybe the principles of PFMI and the systems that operate within those principles will bubble up to the top, and people may have more of a preference for something that's a little bit more sound and solid versus something that is maybe operationally less mature. So in that sense, I think that's a good bar to set, and that's a good competition. And Keith, you mentioned kind of the education aspect to the end consumer. I think that more nuance and kind of financial literacy is indeed required for customers that engage with these type of financial products.
Absolutely.
Well, our time is up, but before I let you all go, I'd like to sort of put one question to you. It's a slightly negative question, I suppose. I mean, the tone of our discussion has really been that these stablecoins are here to stay. They're going to be brought inside the regulated perimeter, and there are lots of things still to be worked out. But on the whole, we think this is going to be advantageous, both domestically and cross borders. But I endlessly run into people who say, well, stablecoins, and this may reflect ignorance in some cases, but not always, are the devil's work. Really the regulators should be stamping these things out. They'll make the funding of banks unstable. They'll continue to fuel the growth of these nefarious activities in the cryptocurrency markets. And I saw a story the other day that Russia and Iran are planning a joint stablecoin backed by gold. So not every one of these 1,000 flowers do we want them to bloom, and they may not even be flowers if they do bloom. So what do you say to people who say that actually stablecoins need to be regulated out of existence rather than regulated so that they become a permanent and useful part of the scene? I won't ask you first, Tina. I'll give you time to hear what the others say. But Ricardo, what's your reaction to that question? Should these be regulated out of existence, or should they remain a permanent part of the scene?
Yeah, we hope not. Listen, I'd say that like any financial technology or new emerging technology, it has the potential for both good and bad. Mm-hmm. So, I think the fact that we're seeing adoption at the institutional level, the fact that we're seeing regulators and governments coming together to look at, regulation and compliance suggests that there is benefits to this new technology. We're seeing kind of benefits in many areas that have been talked about here today and many others. Increased efficiency, accessibility, visibility across the ecosystem and the networks and so on. So I think it's like anything else, you can use it for good and bad. I think we are edging towards more goodness than badness. We've seen a lot of fallout recently, so I think that obviously pinches a little bit. But, I remain hopeful. I think there's tremendous opportunity with this technology. So my view is it really is up to the individuals who look at this to make up their own minds. whether it's the devil's work or not. But my views is, yeah.
Keith, thanks, Ricardo. Keith, what's your take on this? Are regulators genuinely enthusiastic, or are they thinking it's just better to have these people inside the perimeter? We can keep an eye on them.
I wouldn't quite phrase it like that, but I think inevitably, we are seeing stablecoin regulation at the kind of vanguard of crypto asset regulation, generally speaking. So we talked about MiCA, for instance, and the stablecoin elements of that coming in advance of more broader crypto asset regulation. And likewise in the UK, likewise in Singapore, for example. So I think the train has left the station as far as the regulatory perspective in that respect, with the exception of algorithmic stablecoins, which, as you mentioned, are seen as an anathema by many regulators.
Yes, I haven't bothered to talk about them at all. Really.
No, I know, and probably for good reason. I think algorithmic stablecoins, the market is taking care of this. It doesn't necessarily need regulators. I think pre-Terra, there was something like 12% of stablecoin activity was around algorithmic stablecoin. It's now down to 1.6%. So I think the market is taking care of that in advance of the regulators in many respects. But I think it is kind of inevitable that we will end up with regulated stablecoins, sound standards that help the market mature and give stability.
But there's regulation and regulation, isn't there? I mean, from what Tina is saying, it sounds like the MiCA regulation is designed to prevent stablecoins succeeding. Well,
that's a good discussion point to have, I think, which I hope isn't the case, because the regulators always have an interest in supporting and maintaining innovation alongside having sound actions and responsibilities and etc. So it's a balancing act between those two factors, and I hope the MiCA won't get that balancing act wrong, and if it does, it will probably have to readjust.
I'm going to come to you last, Tina. Daniel, your thought on this question: should they be regulated out of existence?
Yeah, sure. I mean,
or not?
I mean, of course, Dominic, I wouldn't put it past you to not end the panel with a controversial question. So thanks for throwing that in there. I don't know. I would say that having a more uniform and consistent regulation in a general sense is positive. And I think to a certain degree, stablecoin arrangements, as they're kind of generally perceived, do engage in some type of regulatory arbitrage, for lack of a better term, to some extent. So I think more unification around that will bring more stability to the market in general. And I think that that's a good thing. If that's overdone or not is a very nuanced art of regulators in each jurisdiction to figure out where the line is between advancing innovation versus providing that stability and oversight that's needed. I think that what maybe I'll shift it to a positive note. I think that what I would like to see more on stablecoin issuers in a general sense is more focusing on the use cases and understanding kind of what are these good for and who are the ultimate users that can benefit from these services. And if you think about kind of the unbundling of banking services into different verticals, I would urge stablecoin companies and stablecoin issuers to spend more time on that problem than anything else. Stablecoins emerged into the marketplace as an on and on ramp into crypto markets. They are generally largely still used for those purposes. Everything else is kind of a little bit more in the air. I would love to see more use cases where stablecoins are used for a niche value proposition within a specific context, and I think that will bring a lot of efficiencies into the market because there's a lot of room for improvement.
Thanks, Daniel. Tina, a last word from you. My question is a kind of existential one for you. So, and you've heard what your fellow panelists have said. What are your thoughts on the regulatory approach? Should it be negative rather than less negative? Is this good? Is this bad?
Well, I think that the regulatory progress and the path that we're on in most of the major market jurisdictions is positive. I didn't mean to imply, and I hope I didn't, that MiCA is anti-stablecoin. I mean, there's certainly a high bar.
That's my interpretation. I take full responsibility for that. But the measures you mentioned made me think, how can you ever make a stablecoin work under these rules?
Yeah, well, we believe you can. I think there's probably lots of potential stablecoin issuers that won't see things are the same way that we do. And it is onerous, but when you're reserving people's money, we think it's important that you are held to a high standard. So we don't shy away from that. I think the balance between harmonization and creating competitive advantages for countries for a variety of different reasons and through different lenses, is something that Mika is trying to kind of approach with euro-denominated stablecoins and non-European currency denominated stablecoins, and what that means for the flow of value through Europe. Your question, of course not. I don't think they should be regulated out of existence. So, that's an easy one to answer. I agree with Daniel that from an industry perspective, we need to be more vocal. It's not that these things aren't happening, but there are use cases every day where this tectonic shift from market speculation, a tool for market speculation, into utility is happening. It's happening already. And so maybe we need to tell those stories better. But I always come back to, if you asked a regulator today about, pulling out these notes and issuing bearer instruments and giving them to people so that they could go spend value, no regulator would say, yeah, that's a great idea. Right. So I think it's far too early to demonize what I see as the next wave of innovation and value transfer around the world.
Thank you, Tina, for those thoughts. Focus on the use cases, education, a very important point that Tina was making there, to overcome the ignorance and visceral reactions many people have to stable coins. But with that, we must stop. We've run out of time, more than run out of time. I'd like to thank our panelists, Ricardo Correa from R3, Daniel Eden from the BIS, Keith Baer from the Judge Business School, and Tina Baker-Taylor from Circle. Thank you also to our audience for your questions and your comments. A reminder, do please look out for our paper on stablecoins when it's published next month. We'll be sending it to you. And it's next month when our next Future of Finance webinar will take place in 2 weeks' time, to be precise, Thursday, 9th of February at 1400 London time on Zoom, as usual. In it, we'll be exploring what cryptocurrency prime brokerage might and might not mean for digital asset markets. And I suspect that stablecoins will come up during the course of that conversation as well. I hope lots of you will be able to join us then. But for now, it's goodbye from the fire.